Chapter 11. Understanding Accounting. We begin our overview of accounting by defining accounting and the role of accountants, including the types of accountants, the services they offer and the tools they use. The accounting equation is explained and the three basic financial statements are discussed in terms of their importance in showing financial activities and the condition of a business. The importance of budgets is discussed regarding internal planning and control. The chapter concludes with a discussion of several important financial ratios. A supplement at the end of Chapter 11 provides material on information technology, IT. The learning objective of today's lesson is that at the end of this lesson, you will be able to explain the role of accountants, distinguish between the three traditional professional accounting designations in Canada, and understand the new unified role of the Canadian Chartered Professional Accounting (CPA) designation. Explain how the accounting equation is used. Describe three basic financial statements and show how they reflect the activity and financial condition of a business. You will also be able to explain the key standards and principles for reporting financial statements. Explain how computing financial ratios can help in analyzing the financial strengths of a business. Discuss the role of ethics in accounting. Describe the evolving role of the modern accountant. What is accounting? Accounting is a comprehensive information system for collecting, analyzing, and communicating financial information. It is a system for measuring business performance, and for translating those measures into information for management decisions. There are numerous users of accounting information, including business managers, employees, unions, investors, creditors, taxing authorities, and government regulatory agencies. Accountants have the responsibility to ensure that the accounting system collects and analyzes data. Controller. Controller is the head of the accounting information system. He or she ensures that the accounting system provides the reports and statements needed for planning, controlling and decision-making. Financial versus managerial accounting. The two main fields of accounting, financial and managerial, are explained and their purposes described. Financial accounting. The firm's financial accounting system is concerned with external users of information, for example, consumer groups, unions, shareholders, etc. Managerial accounting. In contrast, managerial accounting serves internal users, managers at all levels. Professional accountants. Historically, there were three professional accounting organizations in Canada. But these three organizations recently united under the Chartered Professional Accountant (CPA) designation. 1. Chartered Accountants. CA firms provided audit, tax, and management services. 2. Certified General Accountants. CGAs also provided auditing services in most provinces, but most CGAs worked in private companies. 3. Certified Management Accountants. CMAs focused on strategic management, and synthesized financial and non-financial information to help organizations maintain a competitive advantage. The new rules. Transition from CA, CGA, and CMA to CPA. All of the accounting professionals currently in the workforce, as well as individuals who complete their studies during the transition period, will refer to themselves as either CPA, CA, or CPA, CMA, or CPA, CGA until November 2022. After that, only the CPA designation will be used. Accounting services. Accountants provide several services for their clients. Auditing. This involves examining a firm's financial records to ensure that they adhere to generally accepted accounting principles, GAAP. Forensic accounting is used to track down hidden assets in a business and to counteract increasing white-collar crime. Detecting fraud. In recent years, there has been much publicity about the failure of auditors to detect fraud. Therefore, when audits are being conducted, forensic accountants may be used to track down hidden funds in business firms. Tax services. Assisting with tax planning and tax returns. Management consulting services. Some accountants and accounting firms provide a wide range of services, including personal financial planning and planning for corporate mergers. Private accountants. Unlike CPAs who operate independently of the firm they audit, private accountants are salaried employees of the firm. However, they perform a great diversity of tasks in a firm, probably specialized in a large firm, for example, financial planning or payroll or taxation, and across the board in a small firm. The accounting cycle. Private accountants use a 6-step process to develop and analyze a company's financial reports. International Accounting Standards Board, IASB. In our globalized economy, users of financial information want assurances that accounting procedures are comparable from country to country. Therefore, the International Accounting Standards Board, IASB, has developed a global GAAP that is being used by companies in more than 100 countries. International Financial Reporting Standards, IFRS. It is a standard accounting rules developed by the IASB. It is used by publicly accountable enterprises and private government enterprises. Accounting Standard for Private Enterprises, ASPE. It is standard accounting rules that can be used by private businesses in Canada in preparing financial reports. Assets and liabilities. An asset is any resource that is expected to benefit a firm or an individual that owns it. A liability is a debt that the firm owes to an outside party. Owner's equity. The amount of money that owners would receive if they sold all of a company's assets and paid all of its liabilities. The accounting equation. Accountants use the following equation to balance the data pertaining to financial transactions. Assets equals liabilities plus owner's equity. Double entry bookkeeping system. All transactions are entered in two ways, showing how they impact assets and liabilities. Any transaction that decreases liability or owner's equity increases on the debit side. Any transaction that decreases assets increases on the credit side. At the end of the cycle, debits and credits must balance. Therefore, the accounting equation is always kept in balance.